You sit in front of your monitors, running automated technical analysis, pulling market data, and trusting that the numbers on your screen represent absolute reality. You are told the market is a perfectly efficient machine, run by the smartest quantitative minds on Earth. You are told your money is safe, protected by fail-safes and regulations. But the truth is, the entire global economy is an illusion, hanging by a thread of fragile, broken code. Beneath the surface, the market is no longer human. It is a war zone of competing algorithms operating at the speed of light, and sometimes, the machines simply break. Today, we are opening the sealed case files on 10 terrifying moments when the financial system completely collapsed. Not because of a recession, not because of a war, but because a single line of code brought the world to its knees. In August 2012, Knight Capital Group was one of the largest market makers on Wall Street. They were preparing to deploy a new algorithmic trading software to handle a new retail trading program. But during the installation, a dormant piece of 8-year-old testing code, known internally as PowerPeg, was accidentally left active on one of their main servers. The moment the morning bell rang, the algorithm trapped itself in a blind, recursive loop. It began furiously buying high and selling low at a rate of 4 million shares every second. The engineers watched in pure horror as their screens lit up red, but they had no idea which of their dozens of servers was causing the rogue trades. By the time they finally physically unplugged the corrupted machine 45 minutes later, the single coding error had cost the firm $440 million. It was absolute proof that modern wealth is no longer physical. It can be entirely vaporized by a stray line of text in a silent, windowless server room. Warren Buffett is the most famous investor in human history, and his company's Class A stock is the most expensive single equity on the market, trading for hundreds of thousands of dollars a share. But on a quiet morning in June 2024, the Consolidated Tape Association, the central digital nervous system of the New York Stock Exchange, experienced a catastrophic software malfunction. An update to their price band mechanism completely failed. Without warning, Berkshire Hathaway shares were suddenly displayed on screens around the world as being down nearly 99.9%. Trading was immediately thrown into chaos. Retail limit orders were trapped, algorithms froze, and up to 40 separate stock symbols were completely halted. For a few terrifying minutes, the monumental wealth of a legendary billionaire was functionally erased from existence by a computer error, proving that even the most solid assets are just pixels on a screen. In May 2010, the global market suddenly evaporated, wiping out $1 trillion of value in just 36 minutes. The S&P mini futures crashed so violently that blue-chip stocks were briefly trading for exactly 1 penny. The media blamed a massive institutional error, but the truth was far more terrifying. It was not caused by a major bank or a hedge fund. It was triggered by Navinder Singh Sarao, a 31-year-old day trader operating entirely from his parents' bedroom in a quiet suburb of London. He had purchased a standard, off-the-shelf trading software and modified it to spoof the market. He flooded the Chicago Mercantile Exchange with massive, fake sell orders, canceling them right before they could be executed. The billion-dollar institutional algorithms read his fake orders, panicked, and began a massive, automated sell-off. The smartest machines on Wall Street were entirely outsmarted and broken by a single kid with a standard internet connection. Black Monday, in October 1987, was the very first time humanity realized the machines had finally taken over. The Dow Jones Stock Index lost more than 500 points in just a few hours, a catastrophic fall of nearly 22%. It was the single worst trading day since the Great Depression. The crash was not driven by fundamental economic news. It was directly fueled by newly adopted automatic trading systems known as portfolio insurance. Large-scale electronic trading was still an experimental concept. As prices began to fall that morning, the institutional computers automatically triggered sell orders to protect their portfolios. Those massive automated sales forced the market prices even lower, which immediately triggered the next wave of automatic selling. Because phone lines were jammed, human brokers could not call in to manually cancel the programs. It was a flawless, robotic suicide pact that nearly broke the global economy. The market demands absolute perfection, and a simple keystroke error in Japan proved just how unforgiving the system truly is. In December 2005, a trader at Mizuho Securities received an order to sell one single share of a company called JCOM for 610,000 yen. But the trader was moving too fast. Instead, they accidentally typed a sell order for 610,000 shares for exactly 1 yen. An automated warning popped up on the screen, but the trader instantly clicked past it. The exchange's computers absorbed the massive sell order and executed it flawlessly. When Mizuho realized the mistake seconds later, they frantically tried to cancel it, but the Tokyo Stock Exchange refused to reverse the transaction. The algorithm had spoken. The catastrophic mistake instantly drained $340 million from the bank. There is no undo button when the algorithm executes. Long before modern high-frequency trading networks, there was the Kennedy slide, widely known as the flash crash of 1962. In an era where physical ticker tapes were the only possible way for brokers to know the actual price of a stock, the market experienced an unexpected surge in trading volume. The mechanical ticker machines physically could not print the paper fast enough to keep up with the overwhelming data feed. By the afternoon, the tape was running nearly 69 minutes late. Because the data was delayed, floor traders and investors were operating completely in the dark, triggering a massive, contagious panic sell-off simply because nobody knew what the real prices were anymore. The fear of the unknown caused the market to violently crash. It taught Wall Street a dark lesson. When the flow of accurate information stops, the market immediately eats itself alive. In May 2012, Facebook's highly anticipated initial public offering was supposed to be the most flawless tech debut in modern financial history. Instead, it became a technological nightmare. The NASDAQ exchange's internal matching engine physically could not handle the sheer, unprecedented volume of incoming retail and institutional orders, compounded by a massive wave of rapid order cancellations. This caused a catastrophic software loop inside the system. Trading was delayed for hours while the world watched. Orders vanished into thin air, and critical execution confirmations were completely lost in the digital void. Market makers and institutional funds lost an estimated $500 million simply because the exchange's code froze under the extreme pressure. The ultimate tech company was completely sabotaged because the digital gatekeepers of capitalism could not even keep their own servers running. In August 2015, a sudden morning sell-off triggered an obscure, automated safety mechanism designed to protect the American markets. The market's automatic circuit breakers, known as limit up, limit down rules, kicked in to halt trading and prevent a panic. But the programming misfired spectacularly. The circuit breakers halted the underlying stocks, but they left the massive exchange-traded funds that track those stocks completely open for trading. This created a massive pricing disconnect. Major, historically safe ETFs were suddenly priced 20 to 40% lower than the actual verified net asset value of the stocks they represented. The automated safety net did not just fail to catch the fall. By freezing one half of the market and leaving the other half open, the code actively strangled the retail investors on the way down. During a long period of historical market calm, retail and institutional investors poured billions of dollars into an exchange-traded product known as XYFI. This specific fund was mathematically designed to generate massive profits as long as the market remained peaceful. But when market volatility suddenly spiked in February 2018, an apocalyptic event known as Volmageddon occurred. The fund's automated prospectus mathematically forced it to buy massive amounts of expensive volatility futures at the exact wrong time just to rebalance its ledger. The algorithm blindly executed its strict instructions, feeding into a death spiral that drove the price of volatility even higher. The code completely cannibalized itself, vaporizing $2 billion of retail investor wealth overnight. The financial weapon worked exactly as designed. It just turned around and fired directly on its owners. In August 2013, the central technological hub of American finance completely flatlined. The Securities Information Processor, the critical digital pipe that feeds all market data to the world, choked on a massive influx of data coming from a single regional exchange. This caused a fatal software bug and an infinite loop of digital traffic. The entire NASDAQ exchange, the home of Apple, Microsoft, and Amazon, was forced to halt all trading. For 3 long, agonizing hours, the heartbeat of the financial world simply stopped. Traders stared at frozen screens, completely powerless to move their capital. It is the ultimate, undeniable proof that the market is no longer a physical entity. It is just a fragile, invisible network of servers that can be unplugged and silenced at any moment. The institutional elite want you to believe these events were isolated anomalies. A minor typo, a broken server, a rogue algorithm. They want you to trust the machine. But when you unlock the archives and look at all 10 files together, a much darker truth emerges. These glitches are not accidents. They are the terrifying cracks in the foundation, revealing that the entire financial universe is nothing more than a digital casino built on a house of cards just waiting for the code to break one final time.